Good afternoon. Welcome to the Simple Plan Live. It's great to be with you. I'm Brad Macbeth, your host. Just going to make a quick adjustment. There we go. All right, so great to be with you today. We are going to dig deeper into retirement planning today and have another look at a simple but very significant aspect of financial planning. Again, you can find us on Facebook at Macbeth Group. Follow us there, and then you'll always be alerted to when these lives are happening or when we post the replays. You can also find us on Twitter at Cash Coach Canada and on Instagram at Macbeth Group. Our sponsors today, thesimpleplan.com. Life insurance. You can get your own personalized life insurance quote at getthesimpleplan.com/quotes. You can also get a calculator for how much you should be paying for your life insurance at getthesimpleplan.com/how much. Sorry, that's a calculator for how much life insurance you should be carrying. Our helpful tool today is the Simple Plan Retirement Calculator. You can calculate there for free what you need to accumulate, how much of a nest egg you're going to need to accumulate in order to reach your goals, and also how much you need to be saving monthly in order to reach those goals. That's at bit.ly/SP-Retire-Calc, bit.ly/SP-Retire-Calc, and that is all lowercase. All right, so today we're going to carry on. We've looked at a number of aspects of a financial plan, at how we make decisions, how different components affect it. And today we're going to look at really one of the most fundamental components, which is rate of return. People are always wondering about rate of return and how much they should be getting from it, but they don't necessarily know why they are so concerned about that. All right, let's just pull our microphone a little closer here. And so the reason is, of course, we're all driven by wanting to get the best value for our money, greed to some extent, what have you. But really, at the core is when we're making a financial plan for our long-term plans, our retirement and such, this has a very profound effect, but most people really don't know how big or small the effect is. So when we're thinking about rate of return, one of the things that we're really thinking about is how much, it sometimes is called risk, but often it's expressed as volatility, but how much discomfort we're willing to endure. I just checked right before we came on, and very shockingly and interestingly, we are now down below 2%, just only less than 2% below the high for this year. And so that means that despite all the craziness that's going on, we are less than 2% off what we were at when we hit the peak in February or so. So that's seems kind of irrational to me, but never argue with the market. So that's where things are at. Now, of course, along that way, we were actually down as much as 30% from that mid-February high late in March. So things were pretty exciting, a little concerning. And that's what we're talking about when we're talking about volatility. To a certain extent, we're also talking about risk. But, what's your appetite to endure that kind of up and down? Of course, the safest type of investment is to put your money in savings accounts or guaranteed investment certificates, which right now are paying, somewhere between 0.5% and maybe 1.5%, 2% if you're really lucky. Oh, you might get up to 3 into the 3 range for a longer term GIC. The other downside to those types of investments is they are taxed every year. The growth on them is taxed every year. So that means that you are not getting all the full effect of compounding because you're having to siphon off some of your profit every year. Now, that's kind of the lowest form of investing, if you will. It's certainly the safest form of investing, but it's not been a very effective form of investing for a bunch of years now just because of historically low interest rates. So when we look at getting into investing in bonds with some risk to them, for example, like corporate bonds or junk bonds or what have you, and then we get into investing in equities, so mutual funds or mutual funds with stocks in them or stocks themselves. Now we start to get into much more uncertainty, which we count as risk in some ways. And so the risk is the risk that you will not get the result that you're looking for, which could be everything from it doesn't grow as much as you'd hope, to there's a loss, to you're completely wiped out. So when we're making these decisions, we kind of want to adjust the risk with the return, with our comfort, and all that kind of stuff. Now, I'm a big advocate of index investing, and that's because you reduce the risk of having to pick which company is going to prosper. You're now just betting on a particular system or market. So when we invest in an S&P 500 index fund, we're just investing in the overall U.S. stock market with the belief that over long periods of time that goes up. Not just the belief, but also the experience that that's what's happened over long periods of time. That takes some element of risk out of it. But of course, there's still risk in that things go up and down periodically. Certainly in 2008, we saw a very big downturn. And recently, earlier this year, and we're definitely in for more volatility, more churn over the next while, just because things are so uncertain in our economy. So what we want to look at is, what does that mean when I'm actually making my plan? Because I can say, well, I want to get this higher return, but I'm only willing to take this amount of risk or endure this amount of up and down volatility. So we have to find our own comfort levels in that, at the same time adjusting our expectations and our plans accordingly. So let's switch over and have a look at that. We're going back to our scenario with our friend Jen Snapper. We're in the base retiring at age 65 scenario. And again, I'm keeping this pretty simple, because what happens when you're making these plans is all these different things where I'm showing you, okay, we're going to vary whether we invest in an RRSP or a TFSA. We looked at that. Well, that has tax implications. Or we're going to determine how long we're going to work. That's what we looked at last time. Well, that has its own implications. And today we're going to look at, well, what about the rate of return? So I'm going to keep it very simple. I'm going to assume that all of Jen's investments are inside a tax-free savings account. That's not particularly realistic. Just, for a lot of people, there wouldn't be quite enough room there to accumulate as much as they might want to over a long period of time. But nonetheless, just to keep it simple. The thing is, when you sit down with a professional to make a full financial plan, you're going to make decisions about all these things, about the registration of your account. Is it a tax-free savings account? Is it an RSP? How long am I going to work? What level of risk am I going to take? What am I expecting in all sorts of other ways that are going to affect my tax situation? And so when we're making those choices, it's a complex situation. I am just trying through each of these lessons to kind of show you what the effect of just varying one of these things is. Of course, you're going to make decisions around all of these things collectively when you make your choices. So, for example, you might say, well, I don't want to take that much risk in my investments, but I'd be willing to work a few years longer. That could be a comfort level that some people enjoy. Others might say, listen, I want out of this job as soon as I can, and I'm going to go, volunteer doing something else for 30 years. So I'm willing to take more financial risk. That's how this question goes. All right, so let's stay logged in there, please. There we go. So let's have a look here. And I have only got one investment account set up for Jen here. That's this tax-free savings account over here. That's her investment. That's all it is. And again, that's a simple example for illustration purposes. Now, if you'll recall, we have this what's called CFM, cash flow management, start age. We have it set to her retiring at age 65. And right now, she anticipates getting $59,707 a year from that. I've got her adding to her tax-free savings account. This isn't exactly realistic because her contribution that she's making, no, actually I think it is. I think I tried to level it out so that she would max out at a certain point. She hasn't maxed out her contributions yet. And then once she maxes out, so you see she's increasing somewhat here, and then by the time she gets up to 8,000, then based on the current rules, she's going to be able to increment in levels of $500 every few years based on the rules for increasing the maximum annual contribution for a tax-free savings account. All right, so you'll notice here we've got her set to earning a rate of return of 8.5%. So that's getting her, with that growth, she's getting to the $59,000 level. So let's say, look, that's a little high risk. I've got it listed as 100% equities, and there could be all sorts of debate over this. But let's say that we went with a more conventional balanced approach. So let's call this 50% fixed income, which would be some types of bonds and such, and 50% equities, and that's coming in at 5.63%. Now let's see, does that, yes, so that adjusted it for all our years going forward, you can see. So now we just have to rerun the sustainable scenario. Again, we'll go from age 65. So bear in mind, based on that rate of return, Jen was going to be able to retire on $59,000 a year. Chug, chug, chug. It takes a while because of very complicated calculation. And so we get down to the managed money, and we are now down to, holy smokes, that's $34,000 a year. Okay, so we just had a drop in retirement income from $59,000 a year to $34,000 a year, going from 8.5% to 5.62%. So we can see what a profound impact that has. That is a big drop. What are we talking about? 59,000, 34, let's call it 35 out of 60. Yeah, so that's 7, 12. So that's about a 40% drop right there. That's going to impact your lifestyle. So, then we might decide, well, that seems a little drastic. But, I would certainly rest easier, worry less about 50-50, but let's go with that very conventional financial planning adage of your age in bonds. So we'll give her, she's 35 years old, we'll give her 35% bonds. Now, of course, you're supposed to adjust that going forward. We're not going to. We'll just leave it at, so now we're at 6.5%, which some would argue is probably high for an expectation during these times. I wouldn't be one of those, but some would. So, all right, let's go back now and run our sustainable scenario and see where that gets us to. Now, of course, one thing that Jen could do is say, well, okay, fine, I'm going to go to this lower rate, but I'm going to work another 3 years, and we saw last time the very significant effect that choosing your retirement age has. So if you decide to work for a few more years, then you don't perhaps feel as inclined to take as much investing risk. All right, let's see what the calculator says. Okay, well, we're back up to 39,000, but it's kind of not what we were hoping for. But many would tell you now that 6.5% is a reasonable rate of return over a long period of time. And again, these are long periods of time. We can't, the shorter the time frame, the less reliably we can project a particular sustained number over a long period of time. All right, so what if we go the other direction? We were at 8.5. What if we go to 9.5? So we'll go 0 on that. And we'll go 100% on this, but we're going to change this. Can we change? Oh, we can. So we're going to go to 9.5. Now, remembering, we started at 59,000 at 8.5. Let's see what this does. Run our, whoop. All right. And here we are at age, no, that's not right. We've got to run the sustainable scenario. Come on. Wake up. Oh, it's still thinking. All right, there we go. As I said last week, that new computer is on its way. Should be here in another week or so. So that should help things to move along a little more quickly. Tick tock tick. So, all right, let's have a look at that. So that's moved us up. Remember, we were at 59 at only 8.5% when we bumped it up to 9.5%. Now we're at nearly 75,000. So, these are significant amounts of money we're talking about, which are going to have a significant difference or impact on the lifestyle we're going to be able to lead when we retire. Now, again, we can't know how things are going to go. So that's why we make projections, but then we review every year and make a determination about, well, how have my projections gone? Do I think things are going according to plan? Or are they ahead of the game, or are we falling behind? And whichever way it's going, how do I need to make adjustments? And there's all sorts of ways to make adjustments. So for example, in our scenario here, another choice you might make, you might say, well, listen, I'm going to take the lower investment risk, but let's scroll down here to the bottom, and we can see this shows us the expected state of Jen's estate when she passes away on December 31st, 2085. And that is her capital assets will be 0. That means she's exhausted her investments, which is what running the sustainable scenario does. It plans to run your money down to 0. And she has this real asset left, so she's leaving behind an estate of $6 million nearly. Well, what is that? That's her house. That's the growth in value of her house and inflation applied to that. And so what we want to look at is after-tax dollars, real dollars, so that is 2020 dollars. That house is actually worth $1.2 million that she would be leaving behind as the asset in her estate. So that's a nice sizable estate. But you know what? She could have instead decided, listen, I'm going to take less investment risk, and then at age 70, I'm going to downsize, or I'm going to rent, or whatever. If I'm going to live in a tent, whatever you want, I'm going to sell my house and let that form part of my assets. And so there's all sorts of tools we can, that's all part of our planning. We can do that and show people how that works out. Honestly, most people aren't inclined to do that. We keep hearing about people downsizing into smaller spaces. Mostly that's not happening, other than in the really expensive markets. You're getting growth in the condo markets. But human behavior has not generally led people in that direction. But you can certainly make a decision to do that kind of thing and let what's really one of your largest assets, your personal home, form part of your assets to help you get through the rest of life. So that's it for today. I just wanted to share with you what we really should be thinking about when we're looking at rate of return. It's not some kind of absolute number of, hey, my next door neighbor, Bob, got 12% last year. Well, I only got 10. Well, that conversation doesn't mean anything except for a bit of, posturing and ego. And, we have clients who have got investments that have consistently for the last 10 years now almost returned about 12% on average. And that's great, but we don't make that 100% of their portfolio. We set their portfolio up in such a way that it hits their risk profile. We also don't want to have all our eggs in one basket in a particular investment because that brings much higher level of risk. So we need to consider all these things, but I just wanted you to see what we really should be thinking about when we're looking at rate of return on our investment. And so that rate of return is about our bigger, longer-term plan. There you go. That rate of return is about our bigger, longer-term plan. It is not simply about some kind of absolute number as to what's going on in the market this week. Of course, we do compare. We want to know that, well, listen, I'm in an equities portfolio. I'm taking a perceived amount of risk, but I only got, this much return compared to what equities did in general. We definitely want to be looking at that, make sure we're getting value for our investment and for the level of risk we're taking. But we don't want to let that be the only thing that guides us. And we certainly don't want it to be the case that we're getting into just measuring, numbers that make me feel good and numbers that don't make me feel good, because you cannot do that. The question of what the number is or what the projection is for the investment rate of return I'm looking for is a complex question. But here we see, plain and simple, the profound effect and impact that it has. So that means that if we take the risk of taking things too small, so we just put all our money in a savings account or a GIC, well, then we have to either dial back how much we think we're going to live on when we retire, or we have to invest much more money while that's growing. And the reverse is also true. So again, thanks to our sponsor. And you can get your free life insurance quotes at getthesimpleplan.com/quotes, life insurance quotes from all major Canadian insurers. And you can also calculate how much life insurance you should be carrying, getthesimpleplan.com/how-much. To get started in this type of analysis, the place you might want to start, and you can certainly see the effects of rate of return here, is on the Simple Plan Retirement Calculator. That's at bit.ly/SP-Retire-Calc. That's bit.ly/SP-Retire-Calc, all lowercase letters. And there you can calculate how much you should be setting aside based on how much rate of return you're anticipating having for what period of time. All right, so again, I'm Brad Macbeth. Thanks very much for joining us. You can find us on Facebook at Macbeth Group. You can also find us on Twitter at Cash Coach Canada and Instagram also at Macbeth Group. Thanks very much for joining us today. We really appreciate you spending time with us. If you have any questions, send them our way. We're happy to answer them either personally or on the show. Great to be with you today. All the best. We'll see you later in the week.